Crypto tax. Have you ever made real money in crypto but hoped the taxman wouldn't notice? For years, some holders did just that. Crypto was new, regulators were confused, the infrastructure to track barely existed. That era is over. Governments have spent the last few years creating the infrastructure to track, trace, and tax crypto. Exchanges hold KYC data, blockchains show transaction histories, and authorities are getting better and better at connecting the two. The IRS has sent tens of thousands of letters to holders advising them to check their past reporting. And HMRC has been issuing nudge letters telling holders to double check they've reported things correctly. And here's what makes this dangerous. They're not going to whales first. They're going to normal investors. People who swapped one token for another on a DEX and didn't think it counted. People who received an airdrop and considered it a gift. People who staked assets on a platform, earned rewards, and didn't declare a penny. Most of these people weren't trying to cheat the system. They just didn't know. You might be asking, why now? In the US, broker reporting for digital assets just moved into a new phase as of 2025 through a form called the 1099-DA. The UK is close behind. As of 2026, UK platforms have been required to collect user transaction data under the Crypto Asset Reporting Framework, with international exchanges following suit in 2027. Before we go further, this is for educational purposes only. This is not tax, legal, or financial advice. Crypto tax rules vary enormously depending on jurisdiction. Always speak to a qualified tax professional. With that said, this video is about understanding how crypto taxes work, what actually triggers a taxable event, how it differs around the world, how it's calculated, and how serious investors approach it. The science. What triggers tax? Let's start with the foundation. The events that actually trigger a tax liability. Think of this as the science. It's pretty much universally agreed upon. What differs is the rate depending on the country. Here's what's typically taxable. Selling crypto for fiat, the difference between the price you bought at and the price you sold, is a taxable gain. Swapping crypto for crypto, this is one that typically catches people off guard, but in many jurisdictions, swapping ETH for SOL or SOL for BTC is still considered a taxable event, with the gain calculated by the time you bought the original asset and the time you sold it, usually denominated in the local currency. Staking and yield rewards often treated as income, valued at the market price of that given day. That can mean every day, every week, or every month, depending on whether the protocol you were using was compounding or not. Airdrops treatment varies, but in many jurisdictions, a token that has market value at the time of receiving it is treated as income on that given day. And yes, even that nonsense meme coin you receive in your wallet that traded at a few dollars for a couple of days, even that requires tax. Now onto what's not taxable. Buying crypto with fiat, you probably already paid income tax on the money used to buy it, holding it, and of course sending to your own wallets. However, that last part comes with a caveat. You have to be able to prove that you're sending it between your own wallets. Otherwise, it could be deemed as a sale. The key takeaway here, and a rule I suggest, is document every trade, every swap, and every transfer so you have a paper trail to refer back to if ever approached. The art, how much you actually know. If knowing what's taxable is the science, then knowing how to calculate it is the art. There are many methods you can use, and depending on the method you do use, can alter your tax bill massively. Meet your cost basis. Cost basis, in short, is what you originally paid for the asset. The gap between your cost basis and what you actually sold the asset for is your taxable gain. A higher cost basis means a smaller taxable gain. If you bought a token multiple times at multiple different prices, you have to decide which coins are you selling at a given moment. That decision is your cost basis method. This is without doubt the most consequential concept in all of crypto tax, and that's what we're going to take a look at now. now. Here's an example. You bought half a Bitcoin 4 times. The first time you bought half a Bitcoin at 20K, the second time at 25K, the third time at 35K, and the fourth time at 45K. You now hold 2 Bitcoin. Then you sell half a Bitcoin when Bitcoin's trading at 50K. That means you pulled out 25K, right? So how much tax do you actually pay on that? It all depends on which coins you sold. Under a concept called FIFO, which stands for first in, first out, you sold the original coins. These were your cheapest coins and you spent 10,000 on these, right? So you have a gain of 15,000. Under HIFO, highest in, first out, you matched against your most expensive coins. Your cost basis of 22,500. That's a gain of 2,500. Same sale, same cash in your pocket, but a 15,000 gain versus a 2,500 gain. Massively different outcomes. At a 20% rate, that's the difference between $3,000 versus $500 on the exact same sale. Now, you can see where this starts to get interesting, but I will say not every method is available in every country. The US allows for specific identification, which includes HIFO if your record supports it, but in the UK, things work differently. It uses a pooling method called Section 104 pooling, which basically averages out the allowable cost across your whole holding for each asset with same-day and 30-day rules layered on top. You don't get to simply cherry pick which coins you're selling at a given moment. The point isn't to pick your favorite method, it's to understand that there are different methods available to you and your calculation is not always absolute. There can be a massive difference between doing it carelessly and doing it properly. Let's take a look at what it could look like across an entire investor journey. In 2020, an investor buys $20,000 worth of ETH. The price of ETH is $400 at the time. He bought 50 ETH. A year later, he moves 10 of those ETH into a DeFi protocol for some staking. Depending on the structure, this can be deemed as a sale. At this time, ETH is trading at 2,000. So for those 10 ETH, he's netted 16,000 in taxable gain. A few years later, he earns a $3,000 airdrop simply for holding in the protocol. Also, something that needs to be taxed. And that's taxed immediately, not when it's sold. Even if he continues to hold the position, he still has to pay tax as if it were income. A year later, he sells his remaining 40 ETH at the price of 2,500 a coin. The proceeds surpass $100,000 against a cost basis of 16,000. That's 84,000 in gains. 4 events, 3 of them potentially taxable, over 6 figures in taxable gain. This can be manageable if planned for, but incredibly painful and expensive if a surprise. Same gains, different country. Let's take a minute to zoom into specific locations. The exact same trades can produce wildly different outcomes depending on where you live. In the US, crypto is treated as property. Many trades, swaps, sales, and income events are taxable, but the critical variable in most cases is how long you held. Sell within a year and tax is calculated normally, around 37% depending on your bracket. Hold longer than a year and the number can drop to 20, 15, 10 or even 0%. The holding period can be absolutely life-changing. And I've seen many cases where it's a few days that makes a difference. If you're right on the edge, sometimes it may be better holding a position for a little bit longer, even at the cost of the position going down if it massively changes the tax bill. In the UK, crypto is treated as a capital asset. The annual tax-free allowance is only £3,000 compared to over £12,000 a few years ago. Above that, gains are taxed at either 18 or 24% depending on your bracket. The UK also has a 30-day rule, so you can't just sell an asset and rebuy it and declare it as a loss. HMRC matches the sale against the original cost as an anti-avoidance mechanism. And I see this catch people constantly because they're looking at US tax laws and trying to apply it to the UK. In the UAE, there's currently no personal income or capital gains tax. It's one of the main reasons many crypto enthusiasts move to Dubai. However, there's a trap that most people miss. Residency and tax domicile are not the same thing. Moving to Dubai does not automatically remove the liability you have in your home country. The UK has strict rules on when you've actually left. and the US taxes its citizens worldwide. A US passport holder sitting in the UAE still owes the IRS. So before moving, consider speaking to an expert. This is a task for a genuine cross-border specialist, not a regular accountant. And then there's India on the other end of the spectrum. A flat 30% on any income from crypto transfers plus applicable surcharges. There's no distinction between long holding and short holding. There's no deduction for any extra expenses. And crucially, there's no offset of losses. You lose 9 trades in a row, but win the 10th, you are still paying tax on that 10th trade. I will say, I think India is one of the most punishing regimes in the entire world. And I think it's very difficult to be a crypto investor in India using losses. We discussed it briefly when we mentioned India, and in many jurisdictions, you can offset taxable gains by your losses. This is often referred to as tax loss harvesting and is completely legal. The idea is simple. Say you've realized a $20,000 gain. Now you've had a bad year and one of your investments is down $8,000 from where you bought it. You can offset that $20,000 gain with that $8,000 loss. Now you're only taxed on $12,000. That can really compound. From a 20% tax rate, you're looking at a difference of $1,600 saved on that single trade. There is a catch, we touched on it briefly. It's called the wash sale rule. A wash sale rule stops you from quickly booking a loss simply to reduce your tax bill. In the UK, it was the 30-day rule we mentioned. Sell and rebuy the same asset within 30 days and the loss doesn't count. In the US, a holder in many cases can still capitalize on this opportunity, but regulators and officials are honing in and trying to close this, so we don't know how long this opportunity is going to stick out. And of course, by the time you watch the video, this may have changed, so make sure you stay up to date. Lesson: losses aren't always painful. In some cases, they can be incredibly powerful, but it's important to understand the rules around them, especially in your particular jurisdiction, the DeFi gray areas. Now, onto the area that catches most people out. It's DeFi. This is where most people's hidden liability lies. DeFi is moving faster than the guidance, and that gap is where your risk hides. Let's take a look at a couple of examples of taxable events in the world of DeFi that don't really make sense once you understand DeFi. So first is wrapping a token. Let's say you swap ETH for wrapped ETH or Bitcoin for Coinbase Bitcoin. That's considered a sale in many jurisdictions. So if the price of the asset has changed from when you first purchased it, it becomes a taxable event. Next, depositing into a liquidity pool. This is where you hand over your assets and get an LP token in return. This, in many cases, can also be seen as the sale of the asset. Once again, meaning you owe any tax on any potential gains. And the same happens when you withdraw. This can also be seen as a sale and it carries tax implications too. Next, lending protocols or staking. When you earn an interest, that interest is likely to be deemed as income. Where it gets tricky is it depends when you actually receive the payout, as many protocols use compounding. So if you're earning, let's say Solana, if Solana's price changes from $80 to $50, if you received it at $80, you're paying income on that amount, yet your principal may be down massively. It's a bit of an extreme scenario, but where this breaks logically is there can be cases where you owe more in tax than you actually have. Next, cross-chain bridges, very similar to what we said about wrapping assets. For the most part, you can get a pass on this. It's like moving things from your own wallets. But if an asset is converted to a wrapped equivalent or a synthetic version, once again, this can also be seen as a disposal. In practice, these are edge cases, and typically there is wiggle room because this is so new. If the published guidance is not very simple, you will just be expected to have a very reasonable outlook on the situation. And this is why it's so important to track, record, and note everything down. I always say to friends and colleagues that imperfect records are still better than missing records. So that's the framework. That's how crypto tax is triggered. That's how you calculate it. That's how it differs by country. And lastly, some of the gray areas that live in DeFi. The holders who navigate this new era of reporting smoothly are not the ones with sophisticated advisors or the smartest strategies. They're the ones with the best record keeping, documented cost basis of every position, a reconciled wallet history, a clear paper trail for every transaction. Tax is not the enemy. Ignorance is. The holder who best understands their position makes better decisions, sleeps better at night, and keeps more of what they've earned. Thanks for watching.